Okay. I'm going to let people trickle in, and as people are joining us here, I'm just going to do a little housekeeping and mention that if you have questions during the presentation tonight, I would invite you to email those to me at lauren@hockett.com. It's my name, as you see it on the screen here, LAUREN @HAWEKOTTE.com. And we will give just another minute here to let people make their way in. Let's see. Okay, good. I think we've got most people joining us here, so I will go ahead and get started by, first of all, thank you for joining us tonight. And for any of you who might not know me, my name is Lauren Hockett. I'm a certified financial planner and owner of Hockett Financial Group. And in the number of years that I've been working with individuals and couples like you, I've walked alongside a number of people who've had to face long-term care needs, whether it be for themselves or a loved one. And even though it's a topic that we might think of as non-financial because we're talking about physical health and well-being, but planning for a long-term care event actually happens to be one of the most important financial conversations I can have with you because it poses one of the biggest risks to your financial security. And when I'm working with you and thinking about this piece of your financial plan, I also think it's very important to ask a lot of questions, like how important is it to you to maintain your role as a spouse, partner, and emotional support person versus being a physical caretaker for your spouse? If you're single, or if you happen to find yourself single when you have a long-term care need, who will you rely on? What kind of family support do you have? Have you talked with your children and other family members or friends about your expectations of them? How do you plan on paying for a caretaker or care facility if that does become necessary? Is there a game plan in place that's been discussed with everyone involved? And at the end of the day, there aren't any right or wrong answers. The important part is making sure that you and your loved ones are all on the same page and that your long-term care plan works with your financial plan. And you don't have to do this alone. I'm here to help with that. And I've also invited my colleague, Brian Langdon from Ash Brokerage, to speak more in depth about the topic with us tonight, to give you insight and information to better help frame these conversations as we work to develop a long-term care plan that works for you. And though this is one aspect of what I do within the context of comprehensive financial planning and wealth management, thinking about long-term care is something that Brian does on a daily basis. So I'm very grateful to have him with us here tonight. And with that, Brian, thank you for being here. I'll turn it over to you.
Thank you, Lauren. You know, I do a lot of these. That's maybe the best introduction to the subject of long-term care I've ever come across. So congratulations.
Thank you. Thank you. Now that I'm blushing, I'll get off the stage here.
Okay. So yeah, hi everybody. My name is Brian Langdon. I work for a company called Ash Brokerage. We're located in Fort Wayne, Indiana. We are the largest privately held insurance brokerage in the United States. We happen to be a strategic insurance partner with Commonwealth Financial, Lauren's broker-dealer. And we focus on insurance products. And as Lauren mentioned, yes, we do this every day. In fact, I've had a number of years in long-term care planning. As we start today on the subject of long-term care, you see the slide says it's about a plan. And I'd like to echo what Lauren said earlier about the topic of long-term care. Long-term care is not about insurance or buying insurance. We will go through some of the options today, but long-term care is about having a plan and, more importantly, communicating that plan to your loved ones. All too often, I get a phone call where a long-term care event has happened. People haven't made their wishes known. They haven't really figured out how they're going to finance it. The care setting that they're not sure about. You know, kids are spread out all over the United States, and it becomes, at a really high stress time, it becomes kind of a disaster as everybody kind of comes together to do the right thing for family members and those they love. And so tonight's discussion is going to be around the topic of long-term care. Hopefully, we'll give you some things to think about. We're going to talk a little bit about Medicare and Medi-Cal that you have there in California. And then towards the end, we're going to go through the private insurance options so that you understand how the concept works. Then after the discussion tonight, if you decide that you would like to explore an insurance option, Lauren's available. We certainly are available also to work with Lauren and her team to help you figure out what's right for you in the process. But again, it's about a plan. So we're going to talk about what long-term care is. We're going to talk about why planning is important. We'll talk about Medicare and Medicaid. And I have an interesting story of working with an individual who currently is in a Medicare facility, a skilled care facility, and some of the challenges that they and their family have in the process. And as I mentioned before, then we're going to transition towards the end of our discussion about into private long-term care options and the concepts and how they work. So let's talk about what long-term care is. Long-term care is help with activities of daily living. Now, if any of you have had loved ones who've needed help, maybe brought a home care aide in, you might have heard that term, activities of daily living. Well, those are eating, bathing, toileting, continence, transferring, dressing. What I like to call kind of the normal activities that you might do in a home. So long-term care is help with that custodial process. Long-term care is assisted living. As I mentioned, custodial care, home care, and adult daycare. We're here in Fort Wayne, Indiana. We have a wonderful adult daycare program that is so developed in today's world. They actually take individuals with Alzheimer's and dementia. They're in a setting where they have them during the day. Those individuals are still at a point where they can be with family members at night. And so the programs, and I think we're going to see this as the baby boomers continue to age, of interesting programs in order to help us out. What long-term care is not is it's not skilled care. When I talk about Medicare and how Medicare works in a few minutes, you're going to hear the term skilled care, and you're going to see how skilled care is different than custodial care in the care delivery continuum. And again, it's just not nursing home. I think a lot of us, when we grew up, when you heard the term long-term care, you immediately thought nursing home. And what you would find in today's world is that most care is given at home. And if it's not at home, it's in an assisted living facility. And certainly around the country, assisted living facilities have developed to the point where they will take individuals who have problems with their ADLs, their activities of daily living. And in some cases, an individual who might have, problems with 3, 4, even 5 activities of daily living, that an assisted living facility has developed to the point where they can take you in and give you that home setting. So let's talk a little bit about why planning is important. We're all living longer. We're living healthier. And as we think about that, going to the doctor, taking our meds, getting out on walks, exercising more, we live healthier, and you can see that life expectancies continue to improve. But as that happens, at some point in life, we begin to slow down. And certainly when people ask me, when most people become that prime age to have a long-term care event, it used to say 80. But the insurance companies that we work with that actually pay claims on long-term care will tell you now it's 82, 83, and that number has gone up over the last 3 or 4 years and continues to rise. A lot of us on the call today may not need help with long-term care until we're 85, 90, 95, but we are living longer. Now, here's the thing about long-term care that I want everybody to understand. Long-term care is pretty expensive today. We at Ash Brokerage hired some new folks to be in our long-term care team, and last year in 2022. So I gathered up a group of the youngsters and I took them on a field trip, and I took them to an assisted living facility here in Fort Wayne. Pretty nice assisted living facility. I knew the head guy in that particular, the head administrator in the facility. And we did a tour because I wanted our team, or some of the folks on our team, to begin to understand how the insurance impacts people who actually have a need. And at the end of our tour and our discussion, one of my colleagues said to the administrator, said, well, you know, we're in a period right now of high inflation. And, you know, groceries are more expensive, gas is more expensive, cars, houses, everything is going up. Has that impacted on the long-term care delivery here in your facility? And he said, you know, I've known Brian for a long time. And he said, I used to tell Brian all the time, expect 4 or 5% inflation here. But in 2021, our inflation was 10% in this facility. It'll be 10% in 2022. And unfortunately, I think maybe in 2023, long-term care will be another 10%. It's long-term care delivery is primarily labor driven, and as labor costs go up, certainly that has an impact on adult daycare, home care, assisted living, and nursing home. Now you can see on this chart in front of you, and I updated it earlier today to try to reflect the long-term care cost in your part of California. So it's a little bit more specific to you. But you look and think about where long-term care is today, and we're looking at annual cost. 88 hours of home care, which would be about 10 and a half hours a day, which would truly let you keep a loved one at home, is going to run about $150,000 a year. An assisted living facility, somewhere between 78 and 80. A private room in a nursing home would be about $135,000 in today's dollars. But it's not the expense today that we have to worry about, because I'm assuming that most of us here on this presentation today aren't ready to have a need for long-term care, and you're in a situation of planning for the future. So it's the future cost of care. And if long-term care just goes up at 5% a year over the next 15 years, it's going to double. So now all of a sudden, trying to keep somebody at home for 88 hours a week or 10 and a half hours a day or a week, but that now jumps up to almost $300,000. Your assisted living now is over 170, and your nursing home now is almost $270,000 in a private room. So if you think about what a short 3-year stay, as you can see here before you, a long-term care event can be quite devastating financially as we look into the future. Again, these costs are mostly costs in your part of California. As I tell most people, you know, a lot of times when I counsel folks about long-term care, they want to focus on nursing home. What I would say to all of you listening today, most people don't end up in nursing homes. In fact, most people who have a plan, won't end there unless there's a Alzheimer's or dementia situation where you're required to have 24/7 supervision. Most people will end up in an assisted living facility or where you want to get your care, which is at home. So my question to everybody out there is what's your plan? What are you thinking about? Years ago, I did a luncheon in Denver, and I still laugh about it. Because I spoke, there was maybe 300 people in the room, and it was a luncheon, so they were all at tables, and I finished, I walked off a stage, and I had a couple kind of waved me over, and then they started asking specific questions. And I finally said to them, so what's your plan? And the wife started talking about what her plan was, but the look of the husband was one of sheer amazement. And when she finished, I looked at the husband, I said, did you know any of this? And he said, no, absolutely not. And I said, well, a lot of times that's my point. You guys are under the same roof. You're both now thinking about long-term care, but you don't talk about it together. A lot of times I'll find families that maybe will think about it, but you won't tell your kids, or you won't tell those people around you, or your neighbors, or your financial advisor, what your wishes are. So again, not only is it important to discuss what your plan is, it's important to communicate that too. So there's some questions you can answer in the process, which is, do you feel like you're going to live a long life? Well, as I mentioned before, life expectancy is going up. We're living healthier. We have modern medicine. We're taking our meds, getting our exercise, watching what we eat. That leads directly to a longer life. Do you agree that the longer you live, the greater likelihood your health could be compromised? You may need some kind of extended care. Well, as you look at the statistics out there, you hear the term over and over again that people over the age of 65, 70% will need some kind of long-term care. Well, that may be 3 days, that may be 3 years. I can't predict the future, but I will say this, that you do find individuals, you live long enough, you begin to slow down, and your health does become compromised where you need a little bit of help. And then finally, and I think this is the most important thing about long-term care planning, is if you needed care, would that have an impact on those you love? Whether you like it or not, a long-term care event becomes a family event. It affects everybody around you. And usually what I find is if there's not a comprehensive plan in place, if there's not good communication about, heaven forbid, if it happened, here's what we'd like to do, everybody kind of comes together. Not everybody is on the same page. I in a joking way, I always like to say that, when you have a long-term care event in a family, the child who lives furthest away tends to have the most to say. And I say that because that child means well, but they don't live in the city where mom or dad, or maybe even both of them, need care, but they're calling all the time, and they're telling their sister and their brother, hey, you need to get over there more often. I'm not sure mom's doing well. When's the last time you called? And not meaning to cause trouble, the child who's closest then eventually gets kind of frustrated in, hey, I'm here. Well, how about you get on a plane, come over here, give up some of your life in order to pitch in the process. And that's where families begin to struggle a little bit on getting on the right page. But again, a long-term care event becomes a family event. So let's talk a little bit about Medicare and Medicaid, because I think it's really important for you to understand how the government works. Now, in your state, it's Medi-Cal, but will the government pay? For years, I don't get it as much anymore, but for years, I used to have people say to me, well, I'm sure the government's going to help me out in the process. And there are long-term care support from the government, but I think you need to understand how it actually works. So we're gonna go to Medicare. And as we said at the very beginning, long-term care, for the purpose of our discussion and planning and maybe a potential insurance option, will focus on custodial care, help with those ADLs. Medicare, after a required 3-day hospital stay, now they don't count your intake day, so you've got to actually stay 4 nights, will pay 100% for the first 20 days. From day 21 through 100, you have a $200 a day co-insurance that goes up every year. Last year was $184.50. But then on day 101, we're at zero. I mentioned a little bit earlier today, I've been working with a family who's actually a financial advisor. He had a stroke. Thank goodness he survived. He's going to be hopefully eventually okay, but he's still bedridden in the process. And he's in a skilled care facility doing his exercises, but his 100 days are coming to a close. And he actually called today to ask what his options were in the process. But do understand that Medicare is going to focus on skilled care, and they're going to have 100 days. Truth of the matter is 100 days is not long-term care. It's short-term care. Now, a lot of times I have people who they'll mix up Medi-Cal and Medicare, or they'll use them together. But understand this, we're going to get Medicare at 65. The Medi-Cal is our social safety net. but there's some hurdles you have to get through in order to qualify for that. So the first being you're required to spend down your assets to about $3,000. So for those of you out there listening who have 401k balances, IRAs, but qualified funds that you've saved so much for, if you go the Medicaid route, you're going to be required to spend those assets down to a total of about $3,000. As I say here in the second bullet, qualified funds, IRAs, 401ks are countable assets for Medicaid. You can't put them in an irrevocable trust to keep them from Medicaid. You have to use them. You have to spend them. You agree to income limits. In most states, it's somewhere between about $100 to $120 a month, not a day, not a week. It's subject to bed availability. So you're going to go where they send you. Now, a lot of states are beginning to explore home care with the Medi-Cal or the Medicaid program in other states, but it's not at a 10, 12, 14-hour a day benefit. It might be a couple hours every other day, maybe a little bit more than that, three or four times a week, but not sustainable to really be able to keep somebody there. Now, some people actually look to transfer assets out. They want to try to hold on to their money and maybe provide them to their children or their grandchildren in order to qualify for Medicaid. But do understand that if you go to Medi-Cal and you do apply, there's a 5-year look back on asset transfer. So they're going to look at checking accounts, savings accounts, brokerage accounts. They're going to look to see if any asset has been transferred out, and in the application process, you're going to be asked about it. You're going to have to prove where that money went. If not, and you try to give it to maybe a grandchild or children, they're going to ask for that money to be recaptured before they actually start the process. And assets can be recovered even after death. So if you've got a husband and wife and one of the spouses applies for, gets on Medi-Cal, uses it for 3 or 4 years, passes, then the remaining spouse stays in the home. They're allowed to keep the home. But at the death of the second spouse, the state could come in, sell the home for the proceeds, then to apply for the next generation of individuals who find themselves needing help with their long-term care. So let's make a transition. So we kind of talked about longevity. We talked about why planning is important. We talked about Medicare being at 100 days. We talked about Medi-Cal being our social safety net. We're glad we have it, but there's hurdles that you're going to have to get through in order to do so. As we look at private insurance options, I want you to understand we're going to talk about concepts and how they work. And if you're out there sitting thinking, well, maybe I need to look at this, I want you to understand how these concepts work so that as you reach out to Lauren and folks in her office, you might be able to say, we listened to that, we understood it. We'd like to understand how one of these concepts might actually impact us and help us offset future long-term care costs. So a couple of things to know about private long-term care insurance options. First, all qualified long-term care plan benefits are income tax-free. Now, anything that we talk about in the planning process or that we offer through Lauren's office, they're all qualified long-term care plans. So you might collect $500,000, $1 million, $2 million of benefits. You won't pay a penny of federal or state income tax. In fact, states would like for you to take the personal plunge into buying some kind of long-term care insurance because then they won't have to pay for you on the Medi-Cal program. You collect benefits one of two ways, either the inability to perform 2 of 6 ADLs, which are eating, bathing, toileting, continence, transferring, or dressing. Late last year, working with a couple, in their mid-80s, the husband actually thought the wife was ready to go through the process of claiming benefits, and the advisor kind of thought so too, but the wife didn't. And so we did a conference call, and I said, well, I asked the husband, I said, well, let me ask you this. In the morning when you guys get up, I mean, do you have to help your wife, from the bedroom to the kitchen, or the bedroom to the living room, or the bedroom to the bathroom? And he said, no, absolutely not. I just have to be standing there to make sure she doesn't fall. Well, that's hands-on assistance. So that would be one of your ADLs and transferring. And that kind of gives you a layman's term of how these ADL work. The other way that you could qualify for benefits is cognitive impairment. Most of us would think of Alzheimer's or dementia in the process. So two separate ways that you would qualify for your benefits, and your benefits are going to be income tax free. So there are basically 4 types of long-term care plans out there. We talk about the standalone or the traditional long-term care. That's been there the longest. And I'm going to talk about each of these in a little bit more detail in a moment. And when I do, there's some things about the standalone long-term care that you need to be aware of. The linked benefit life hybrid. So some companies, in response to people saying, what if I bought the standalone, the traditional long-term care that kind of pay as you go, and had it for 30 years and never used it, and then I passed. And so companies started matching up life insurance and long-term care, created that they work the same way, the benefits are triggered the same way, the benefits are income tax free. But later in life, if you don't use your long-term care benefits, or you use a very small amount of them, the life insurance then pays back your estate for the amount of money that you put into the plan. You can do the same thing with an annuity. And our third option is matching an annuity and long-term care. And then finally, you can there's a rider out there that you can attach to a life insurance policy that says, hey, I have a $300,000 permanent life insurance plan. If I'm unable to do my ADLs, or I have a cognitive impairment, I'd like to reach into that death benefit and pull dollars out at 2, 3, or 4% a month, and to help offset my long-term care bill. You can do it. The benefits are received income tax free. As you can imagine, your death benefit reduces with the amount you take out each month, but gives you the flexibility of having life insurance and long-term care. So let's talk a little bit about the standalone long-term care, or the traditional. I like to say that's kind of like your homeowner's insurance. We all have, I'm in my home tonight. We all have homes. We insure them. We hope nothing ever catastrophic happens to our home, but if it did, we're glad we got the insurance. Well, the standalone long-term care is the same thing. You would put a plan together, and I'm going to show you specifics in just a minute, by selecting a daily or monthly benefit. Now, in today's world, most plans are monthly benefits, which is better off for home care, because often home care claims start not necessarily the same day, 4 hours a day, every day. Early on, home care claims might start with 2 hours on a Monday, 4 hours on a Wednesday, 6 hours on a Saturday, or maybe you're still living with a loved one, and the loved one kind of watches after you during the week, but on the weekend there are things to do. Maybe they're going to go see the kids participate in an event of some sort, and so maybe they need to be gone for the weekend, so you can get 24/7 care on your weekends. That's where the monthly benefit comes in, and most plans in today's world are monthly benefits. You might select a 2, 3, 4, or 5-year benefit option. You'll almost certainly put some kind of inflation option on it. 3% tends to be the most common today. You'll have an elimination period. An elimination period in long-term care is very similar to a deductible for health insurance. And the elimination period tends to be 90 days. So what that says is, you can't perform 2 of 6 ADLs. The insurance company says, okay, we approve you for the claim. The first 90 days are going to come out of your pocket. Now, the last bullet's really important. It says recent stability. If you do any research on long-term care insurance, you're going to find the biggest complaint is that policies bought 25, 20, 15 years ago, some 10 years ago, but much less, have had enormous rate increases. People bought them 25 years ago, and today their policy premium has doubled in the process. And so I counsel advisors and their clients often, don't make the mistake of thinking what we're looking and going to look at today is the same thing you could have bought all those years ago to get the industry into trouble where they have to go to the state and apply for increases, because they're not. Insurance companies have brought the benefits down, they've raised the prices. All states now have a rate stability act where they've said to the insurance companies, don't come and file a product in our state and then say to us, hey, we made a big mistake on pricing. Do it up front, make sure you do it in a low interest rate environment, and stress test it to make sure your rates are okay. So those policies have been bought over the last 10 to 12 have had no increases in the process. I can't guarantee that will be, but I did talk to my brother and sister-in-law about this type of plan over the holidays. They're interested in it. And I did so without the worry of large future rate increases, because I think the companies have learned from the past, and they're going to have more stable rates on the policies that they're selling today. So, a lot of times when I talk long-term care, the one thing that all of you have to keep in mind is it's not only the benefits that you derive, but how are you going to pay for it? How much are you going to pay for it? And that's part of the planning process. I've not been a big advocate of saying, I have to insure my entire long-term care risk. And the reason I don't know that you have to insure the entire risk is some do and some don't. Not all of us are going to have a extended long-term care claim. We may need long-term care for a week, a month before we pass. And that is something that we can all handle out of our pocket. The insurance should come for those 2, 3, 5-year events that will, as we saw a little bit earlier, result into a large bill. So as a starting place for a lot of folks, people will look at $5,000 a month. 5,000 times your 12 months is a $60,000 a year benefit. Coverage for 3 years, which will give you an initial pool of $180,000 of income tax-free benefits. Inflation coverage, you could buy as low as 0 if you didn't want to put inflation on it. I'm not sure I'd recommend that. But 1 through 5%. 3 being the most common. And then, as I mentioned a little before, you've got an elimination period that tends to be 90 days. But with these basics that you see in front of you, you could call Lauren and say, hey, if I listened to the presentation today, I want to get an idea of what something would cost. Let's look at kind of a boilerplate standard. Now, you may ask for a little bit more, you may ask for a little bit less in the process, but this gives you an idea of how you construct benefits and in order to find out what the price would be for you. So let's move to the linked benefit life insurance. It's life insurance with a long-term care rider. It's not a get right into the death benefit like our last example that we'll talk about, but it's move money around to create some leverage. Sometimes people will have cash value in a life insurance policy today. Maybe you've had it for a while. Now you're in your late 50s, your 60s, and you're like, kids are gone, house is pretty much paid off. I have less of a need for life insurance, but I have this policy with cash value. I don't know what to do with it. A lot of times people will do an income tax-free exchange into a policy like this. You'll have less life insurance, but you'll have a lot more in long-term care benefits. You're going to cost share your coverage. So you're going to pay into this type of policy. But early on, and you'll see it here in just a minute, you're going to actually draw down your death benefit first before the insurance company steps in with their leverage. But you'll retain control of your asset. This will be an asset that if you ever said, hey, I want to take my money off the table and take it back, you won't, and people don't, but you could in the process. And then the last couple of things I'll say about this type of plan before I show you actually how they work is that there are some plans out there that will do an indemnity. And what that means is when it comes time for your long-term care benefits, and maybe you qualify for $10, $12, $13, $14,000 a month, what the insurance company does when you can't do your ADLs, or you have a cognitive impairment is turn around and give you an income tax-free check for your benefits. So instead of saying, okay, you're getting home care, you pay the home care agency, you submit your bills, you get them reimbursed, which is a reimbursement plan, we're going to pay an indemnity. So you can hire whoever you want to come in and provide care for you. If you want to give that to your loved ones, your children to watch after you can, you want to do it to somebody down the street that you've known for a long time that you're comfortable with, it gives you really greater flexibility in home care. The other thing that we didn't used to have for long-term care for a while was a lifetime benefit. There's now a company out there that would provide a lifetime plan. So sometimes I run across folks who really worry about Alzheimer's or dementia. They worry it runs in the family. They think maybe they're at higher risk for it. So we could steer you in the direction of a plan that would provide lifetime benefits. So let me give you an idea of a 60-year-old non-smoker who resides in the state of Texas. In this case, they decide to do a deposit of $100,000. Now, these plans will allow you to do a 10 pay. These plans will allow you to do a 15 or a 20 pay. They will allow you to do a life pay. This just happens to be a single pay in this process. Does it at age 60? By age 80, 20 years later, that $100,000 is now turned into $900,000 of income tax-free long-term care benefits at $9,100 a month, and with a $100,000 death benefit. Again, you don't use it, you put the $100,000 in, you don't ever use it, the $100,000 goes back to your estate. So let me show you kind of how it works. So you can't do your ADLs, you have a cognitive impairment, the insurance company approves you with this type of plan, and you start collecting benefits. Well, they're going to draw down the $100,000 death benefit first. Now they have a residual, so if you exhaust the entire $100,000, there'll still be a $10,000 or $15,000 benefit at death, at what we call a residual benefit. But you're actually using your money, so the client contribution comes out first. And remember, one of my bullets, I said, you know, you kind of cost share your long-term care. It's kind of like a high deductible long-term care plan, because you'll use your money first with long-term care. When the $100,000 is exhausted, then the extended benefit kicks in, and you've got an additional $800,000 of long-term care benefits that is available to you. This has become extremely popular in the long-term care space when it comes to insurance planning. The benefits here are guaranteed. The rates can't change. The rates can't go up. The insurance company can't say 20 years from now, hey, we made a mistake. You know, we need to adjust things. So this is probably the most popular long-term care plan that's out there today. Now, you have a very similar thing with what we call linked benefit annuity hybrid. So you can take an annuity and you can add long-term care benefits to it at 2, 3, maybe even 4 times your deposit. You know, we have some people out there that have a long-term care or have a non-qualified annuity, maybe that you've been holding on to, or you funded for healthcare costs and retirement. Well, you could do an income tax-free exchange and move into a policy like this that has long-term care benefits in it. Your annuity will still grow. It won't grow quite a bit as other annuities out there, because you have your long-term care benefits tied to them. But again, you won't pay any taxes on using your annuity or your gain or your leverage for long-term care. You may have an annuity in your name. Now you're going to be able to add your spouse to it and cover both of you in a joint plan with long-term care. Your non-qualified gain can be used income tax-free, as I mentioned a little bit before, and you completely retain control of your asset. So again, if you decide to move it later on in life, you can do so. And our last option that I would talk about this evening is the accelerated benefit life. So it's traditional life insurance with a rider, and you spend down that face amount for long-term care if you can't do your ADLs or you have cognitive impairment. So maybe you have a $300,000 face amount life insurance plan with a 2% rider. 2% of $300,000 is $6,000. you can't do your ADLs. A lot of these plans, again, have a 90-day elimination period. And after that 90-day, then you start pulling down $6,000 a month. So your face amount might start at 3%, or excuse me, 300,000, but now you're down to 294, 288, 282. If you pass and you still have the 282 there, you go ahead and you get an income tax-free life insurance check for the balance of the amount. Last thing about this is some of the plans, again, will pay out that monthly benefit as an indemnity. And people find that quite attractive to be able to organize and figure out who they want in order to provide them with their long-term care benefits. So let's kind of go through what we talked about this evening. We talked about the fact that we're all living longer. We talked about the importance of long-term care planning. Why? Because the costs are there and the costs continue to rise. And we know that if we live a long life, at some point in time, we may slow down and we may need help. And long-term care could become not only an event for us, but those around us and our family members. We know that Medicare pays for 100 days a maximum. We know that Medi-Cal will have some hurdles in which we have to spend down our assets. We have to agree to income limits. Then we kind of turn ourselves over to the state and they point in the direction of where we're going to go, primarily in a nursing home. When we made the shift to the private long-term care insurance options, we know that there's 4 of them out there, kind of a traditional pay-as-you-go, all insurance long-term care plan. We know that we put a life and long-term care, what we call a linked benefit plan together, where the life insurance and the long-term care insurance work together. We can do the same thing with a non-qualified annuity. And then finally, we know that we could buy traditional life insurance and then take out of that death benefit each month should we not be able to do our ADLs or have an issue, a cognitive issue where we need some help with our long-term care bills. So with this, we'll wrap it up and I'll bring Lauren back. And if there are any questions in the process, we're available for you.
Thank you, Brian. That was extremely comprehensive and a lot of information. I'm sure there will be questions. I do actually see that a couple of people have raised their hands. And if I could ask, if you have your hand raised and you do have a question, if you could send it over to me written out in an email very quickly, if you have access to do that. If for some reason you don't, please feel free to reach out to me afterward, and I'm happy to address your questions and or loop Brian in to answer them as well. And while we wait for some of those to maybe come in, Brian, I've got some questions I'll throw at you that I
Sure.
commonly encounter from people as we're talking through this process. One of the questions I hear a lot is, you know, that's great that I could have the insurance and it sounds wonderful, but are they really going to pay me when it comes time to have this happen? And who approves me to be eligible for this? How does that piece of it work?
So understand this. What you get with an insurance policy is a contract, and it's called a guarantee renewable contract, where you pay the premium, they have to provide the benefits. What I find in the process of getting a claim paid is you've got to follow what the company instructions are. These companies are not hard to get a hold of. They're usually really accommodating in the process of saying, hey, here's the stuff we need. I will share with you, I think it takes a little time to start the process, but once it starts, it works extremely well. Where, you know, they've verified the person can't do their ADLs or have a cognitive impairment, and they go ahead and do so. The complaints sometimes that I hear about, well, my mom, my dad, somebody had a long-term care policy and they didn't pay. Part of the qualified long-term care language that allows long-term care policies to be income tax-free says your condition must go, a physician, actually it says medical practitioner, must certify that your claim will go at least 90 days. Well, sometimes people have a hip replacement, shoulder replacement, and they're thinking, okay, well, I'm gonna get my long-term care policy to pay. In a situation like that, you're not going to get somebody to certify at least 90 days, and that wouldn't qualify.
Okay, that makes a lot of sense. Let's see here. We've got, I don't see, you must have done such an amazing job explaining everything that there aren't any questions coming in. But I'm trying to think of what else. Is there another common question that you hear that we could address? Because I'm sure some people might.
Yeah, a couple of them.
Yeah.
One of the things I hear a lot of times, people reflectively say, well, this stuff's too expensive. There's no way I can do it. And my response is to always, then you're going about it the wrong way. I find sometimes people who don't do a lot of advisors who don't do a lot of long-term care, somebody asks them a question about it and they throw something at them and say, here's what your options are. And they usually are pretty limited in scope, and usually the premiums through the roof, and people go, well, I can't do it, and walk away. That'd be a shame, because I just went through 4 separate different options that create literally millions of different ways to go. Process. And what I always say to folks is, if you're interested, come to the table and go through it. Ultimately, it's your decision on what you do. But be mindful of what your options are out there. That process just takes time, not money. Then the other question sometimes I get is, well, which direction should I go? And what I find is, through usually more than one conversation, but over the course of a couple different conversations, maybe 3 or 4 times, you look at different options and you go back and you fine tune them a little bit, and you talk about them again, and eventually people become very comfortable with where they are in the process. And then the last question that I'll bring up is specific to the state of California. Your state is very seriously thinking about a comprehensive California long-term care plan that happened in the state of Washington. And what I would say to everybody out there when it comes to your state of California plan is, they're going to attach a tax to it. And if you have not done any private long-term care planning beforehand, so that you already have a policy, you're going to have to participate in a plan. If it follows the state of Washington, and most of the states do, you're looking at most $100 a day for a 365-day period of time. No trigger for any cognitive event, and the trigger in Washington is 3 of 7 ADLs, and so it's harder to qualify for. And so I think it's important to watch what the state's doing, and don't get caught short in the process.
I think that's a very important point. And interestingly enough, what I would say to those listening is, you may be thinking about long-term care insurance for yourself, but what Brian just said, really, I would invite your adult children who are younger and in their highest earning years would really be affected by this tax should it be implemented. And so I would encourage you to encourage them to start thinking about this now. It's not necessarily something that someone in their 30s and 40s would be thinking about, but it might make a lot of sense depending on the situation.
Yeah, especially if the tax in Washington, I think it was 54 basis points, so 0.5%. A 0.5% for high earning folks over their career is a lot of money for a very, very limited benefit.
Absolutely. So I did have another question come in, and this gets back to something we touched on a little bit earlier. And the question is, in the different types of private insurance contracts, who is assessing the client's ability to perform those ADLs? So is it their doctor submitting the information to the insurance company?
That's where the process starts. So as I mentioned before, and the way the contract's written for all the policies is, a medical professional has to certify that you can't do your ADLs or you have a cognitive impairment, and that condition will last at least 90 days. That tends to be your doctor, but it could be a physician's assistant in the office. It could be an RN in the office in the process. And then what you do is you go through the process of making sure that somebody is ADL dependent. What I found over the years is physicians won't certify it if you're not there.
Mhm.
I've seen it over and over again. Even a family doctor that's been with them for 20 years, 30 years, they'll play it straight down the line. And if you can't, you can't. Here's what I will always tell people about long-term care claims. You got to remember, when you file, you're probably going to be older. State departments of insurance and insurance companies do not want a bad story of somebody really upset because a claim didn't get paid. What I have found is if you are truly ADL dependent or you truly have a cognitive issue, you will get paid.
Yeah. Okay. Another one to throw at you here. How do you determine, is there a rule of thumb for determining how much coverage you get? So how many years of coverage you might need, as an example?
Yeah. So if I go to the insurance companies who are paying claims on this stuff, what they will tell me is a male will go, if somebody is ADL and somebody's certified that your condition's at least 90 days, a male will go about 3 years, a female will go a little less than 4.
Mhm.
And so if you do a plan at 3 or 4 years, you're going to take care of 95% of the risk. Now, if you've got an early onset cognitive issue, all bets are off. That's a bigger planning question, but in that scenario, if you got a 3-year plan or 4-year plan, your insurance takes care of most of it. You might be a year out of pocket, but now you've moved your assets out in order to take advantage of whatever the state can do for you in the process. So somewhere in the 3 or 4 year range.
Yeah, that's great. It's a great starting point. And then what I would layer on to that question is to say, it really also depends on your individual situation too. So what I really enjoy doing and working with you, Brian, is getting and comparing the various options for someone. And then looking at how does that layer into your current financial plan and your current situation? And how do we best leverage what you have available to put toward the long-term care to get you the best benefit, taking into account something I see a lot of times, and maybe you can speak to this too, is people really become sometimes immobilized, wanting to solve for all possible scenarios, when the reality is, I agree with what you just said, you kind of have to go with statistics at some point and say, you've covered 90% of the likely outcomes. Sometimes you're going to have that 10%, but we can't delay in hopes to solve for 100%.
No, you don't do perfect. And some of the things you have to remember, and I would encourage everybody out there listening to us, is you're going to have other sources of income during your retirement, Social Security, income off of savings, maybe a pension. I mean, there are different income streams that you have. What we try to do with folks is to say, okay, you pretty much you've done your planning with Lauren. You kind of know where that's going. You know what your savings are. You know what your income is. A lot of people know about what they're going to need to live off of. But if you have that long-term care event come in and that pokes a hole in it, what helps you put a Band-Aid on that? Is that going to be $8,000 a month or $10,000 a month in benefit, 15 or 20 years from now? And so I always say that a long-term care insurance policy should be part of your financial plan, not your entire plan.
Yes. And on the flip side of that, I think that there are very valid reasons for someone who maybe feels like they have plenty of resources to self-insure financially to consider utilizing insurance, even though they theoretically could pay for the expense themselves.
Lauren, I've done this for a really long time, and it's been my pleasure to work with some really, really high net worth individuals. And I always ask them the same question when I start the process with them. I know something about your financial situation. Usually you've got somebody whispering in your ear. If you have a long-term care event, um, you can buy your own facility if you want to do it. So why are we starting this process? And I had a lady kind of pull me up short last fall and say, that's somebody who's never gone through this before. Yes, I can write the check, but I am never going to put my kids through this process. And so let's sit down, let's figure out what the right plan is. You have to understand, higher net worth people are going to get the best care. We could go back and look at our slide on what home care costs were, and that was 10.5 hours a day. That wasn't even 24/7. And so understand this, that yeah, we can do it. But at some point in time, you insure other things. You would have hoped you would have insured this.
Yeah. Yeah. And not only from my perspective too, in working, very closely with people, it's not even just about that portion of it too. It is, like you said, it's about not putting your kids through this. It's about not putting your spouse through this, because the reality is, even if you can, let's say you're not an ultra high net worth individual, but you have sufficient resources to pay for coverage, the tendency, in my experience, from what I've seen, is going to be to delay spending money on it for as long as you possibly can. And that creates a situation where you are now the caretaker for your loved one, as opposed to being their partner and support person and enjoying this time that you have together. And I find in some cases, I've seen it, that insurance just allows people that peace of mind to relax into bringing someone into the home to take on that role. And there are just so many considerations with this. And
Absolutely. How many times do you hear the caregiver wears out before the person receiving the care?
that is the first question I ask people when I know they are acting as a caretaker, is what are you doing to take care of yourself? Because that is absolutely critical. And I think we've touched on so many really important points today. And Brian, I just appreciate the level of expertise that you have, how eloquently you've shared all of this, to really give us a starting point to think about, for those of you who haven't yet thought through this process, how to think about it, the information you need to understand the costs of it. And at this point, I will be sending everyone who's watching today a follow-up with a link to the replay for this too. So if you didn't catch some pieces, or you want to go back and listen to something again, you can. And then I'll also follow up with you with some next steps on what you can do to make sure that you've got a really solid long-term care and plan in place to protect you financially, and also to protect your family and your loved ones in the whole process. So thank you again, Brian. And
Thank you.
thank you everyone for being here and participating, and be well. Good night.
Night.